Is the housing market recovering? Builder confidence continues its upward swing. Michelle has a look at the economic data that could provide a little bit of clarity going forward. Of course, going forward, you never want to go backward, Michelle. And it's interesting that these markets the market tone completely swallowed up and offset this news. It's almost like nobody really paid attention to it.
Well, Bernie, we've been getting such a mixed picture on the economy these days that I suppose we want a few very solid good points before the market responds. Now, as you mentioned, we did have some bright spots in the economic data, particularly in the housing market, with the National Association of Homebuilders Confidence Index climbing to 18 in July. That is the highest level in a year. The gauge reached a record low of 8 in January and averaged 16 in 2008. So the lower prices and the government tax credits for first-time buyers do seem to have stabilized home sales, and this has set the stage for builders to gradually step up construction from those record lows.
The first-time homebuyer tax credit, I think, has been one of the largest reasons why the builders have seen some sales improvements, some traffic improvement, and particularly their expectation for the next several months is particularly buoyed.
Now, though housing may be showing some signs of stability recently, skeptics say this hardly means a near-term rebound. Housing starts as well as existing home sales have all posted 3 consecutive monthly gains, but those all followed ultra-depressed levels in January, and we're basically back where we were 6 months ago. New data this week likely to reflect that mixed picture. Economists do forecast that housing starts rose 2.7% and that sales of previously owned homes probably rose to a 10-month high. But keep in mind, new home sales as of June, half of what they were in 2007. Housing starts 30% of what they were at their 2006 peak. Existing home sales, which are benefiting by the boom in foreclosures, are still running 25% below their 2006 high and are still lower than a year ago. So it's very important to keep all of this information in perspective. But another good sign, manufacturing in the New York area grew in August for the first time in more than a year. The report suggesting that inventory cutbacks coupled with the government stimulus plan are actually helping the economy rebound. So, Bernie, two good bits of information to end the report on. We'll see what the data for the rest of the week holds.
Absolutely. And hopefully they'll find some sweet spots to release this data instead of getting overwhelmed by the China syndrome like we saw. Thanks, Michelle. McCory, New York. Ray Barros returns to us from Singapore. Now, have you been listening in, Ray? You've heard Abby Joseph Cohen kicked off that string of comments there a little bit earlier, heard from another economist. And then housing, some reason for optimism, and manufacturing, Empire State, reason for optimism there. Are these the catalysts that you were referring to in our last chat?
Yeah, possible. I think we need to put my comments in perspective, though. I mean, if the market does get back up to the 1,500 level, I think that's just a selling opportunity because it's going to come all the way back down again. We're basically in a sideways market till 2015, 2017. We're not going to be starting any new bull market anytime soon.
Okay, what's going to take us all the way down then? I mean, we heard Abby Joseph Cohen saying she didn't see a W shape, and then a second commentator there just a second ago was saying, in fact, there's more signs of a V shape. But you're saying we are looking at a W sort of pattern there. If you're talking about zip up 1,500, come crashing down again. Okay, so this is a slightly different set of parameters that you're utilizing here.
Yes, that's right. And in terms of the fundamentals, I think the key hidden factor, I suppose, will be the money supply that the Feds are producing at the moment. It's not getting out to the economy. St. Louis Fed reserves are still fairly high, so it's not getting out there. When it gets out there, the inflation rates are going to go higher, and then they're going to have to raise rates, and they're hoping that by the time they do that, productivity will be back online. I don't see any signs of that at the moment, so I think that if we do get to 1,500, that will probably be the catalyst that will bring it back down.
Okay, we looked at the S&P year to date a second ago. Let me get him to bring up the DJIA, the Dow Jones Industrials, and obviously on a one-year view, the pattern is going to be quite similar in a lot of ways. But Ray, if we're looking, I mean, if we've concluded, at least for the purpose of this program, that the Standard & Poor's looks primed for new reaction highs in the next weeks, and we're going to rally into October, November. What about the Dow? Any difference of opinion there? A very, very different set of metrics there. We're talking about 30 versus 500 counters contained within.
Yeah, I don't think that the Dow is very much different. I mean, the S&P and the Dow are very correlated, but just go back a little bit. I'm actually looking for the market to come down into October, into the end of September, early October, and then rally into the end of the year. And I think the Dow will be doing exactly the same thing.
Okay, yeah. This marks the high until October, November rally, and then we get going well into the next year. How does this dovetail? How does this dovetail with the state of the dollar right now? Obviously, you look at these two metrics here, but in the same breath, you're also going to look at dollar dynamics because that does play a role in this. Where is the dollar poised for right now? As of late, the general direction has been Europe's got more problems than America does for a change, and that's going to be a catalyst for greenback interest.
Yeah, Bernie, traders have a comment that we should diversify our portfolio. Unfortunately, at the moment, everything's tied together. Everything's tied to the U.S. stock market. The dollar's inversely correlated to the U.S. stock market, and the commodities are inversely related to the dollar. So if the stock market pulls back, I think the dollar's going higher. First target's going to be around basis the DX around 81, 70, 82, that area. And if we can get through that, we're going to go all the way back up to 91. We need to get through 92.50 for the bear market and the dollar to end, and I don't think that's going to happen.
Okay.